Assalamualaikum and good afternoon. Let us continue our discussions on the behavior of interest rates. In these second parts of this video descriptions, we will look at the two more subtopics related to the interest rate behavior. Under the subtopic of the liquidity preferences frameworks, we will understand or we will learn what is the liquidity preferences. It is the demand for money, or often known as liquidity. Money is the most liquid asset, which is the faster an asset that can be changed into money, the more liquid it is. There are two main categories of assets that people use to store their wealth. The first one is money and the second one is bonds. Total wealth in the economy is when BS plus MS, which is the bond supply plus money supply, equal to bond demand plus money demand. And we rearranging it to BS minus BD is equal to MS minus BD. If the market for money is in equilibrium, we can see that MS is equal to MD. Then the bond market is also in equilibrium when BS is equal to BD. There are three factors that influence the movement or the shift of the curve of the demands for money. The first one is income effects. A higher levels of income causes the demand for money at each interest rates to increase and the demand curves to shift to the right. The second one is price level effect, which is a rise in price level cause the demand for money at each interest rates to increase and the demand curve to shift to the right. And the last one is money supply. The LM curve shifts to the right or to the left when the money supply, which is real money balance, increase or decrease. It is also shift to the left or to the right when money demand increase or decrease. The easiest way to see this is to first imagine a graph where money demand is fixed and the money supply increase, or we call it a shift to the right, leading to a lower interest rates and vice versa. You can see more clearly the movements or the shift of the curve in the flipbook provided. In there, the change of the curve, the effects of these three factors has been shown more clearly in that flipbooks. Now let's look at the effects of price levels and the effects of inflation expectations on interest rates. The first one is price level effects. The money supply will cause price to rise to a permanently higher level by the end of the year. The interest rate will rise via the increased price. Price level effect remain even after price have stopped rising. A rising price level will raise interest rates because people will expect inflation to be higher over the course of the year. When the price level stop rising, the expectations of inflation will return to zero. As a result, an increase in the price level, which is inflation, will result in an increase in the economy's average interest rates. In contrast, a drop in price level, we call it deflation, will result in a drop in the economy's average interest rate. This curve shows the link between the interest rate and real money due to the changes of the price level. From the curve, you can see that suppose the money market is originally in equilibrium at point A, which is due to the effects of the price level increase with real money supply MS P prime and interest rates I. Suppose the price level increases, which is ceteris paribus, which we assume that all other exogenous variables in the model remain fixed at their original level. It means that the money supply, which is MS, and the real GDP, which is Y, remain fixed. The increase in the price level caused a decrease in the real money supply since MS remain constant. In the adjoining diagram, this is shown as a shift from MP prime 1 to the MP prime 2, which is moving from A to B. At the original interest rate I, the real money supply has fallen to level 2 along the horizontal axis. while real money demand remains at level 1. This means that money demand exceeds money supply and the actual interest rate is lower than the new equilibrium rate. Adjustments to the higher interest rate will follow the interest rate to low equilibrium story. The second effect, called expected inflations. In economic, inflations, or less commonly price inflations, is a general rise in an economy price level over time. When the general price level rises, each unit of currency buys less goods and services. As a result, inflation indicates a loss of purchasing power per unit of money, a real value of loss in the economy's mediums of exchange and units of account. Interest rates and investment are both negatively affected by inflation. High inflation raises interest rate and reduces the quantity and value of investment projects that are possible. Because banks lend money, they must be able to recoup the same purchasing power in the future while still making a profit. Expected inflation effect persists only as long as the price level continues to rise. The curve shows the link between the quantity of bonds and the price of bonds due to the effects of expected inflations. From the initial equilibriums, E1, it will show the increase in expected inflations reduce investor expected real returns and reducing investor willingness to buy bonds at any bond price. The demand curve for bonds shifts to the left from D1 to D2. The increase in expected inflation increased firm willingness to issue bonds at any bond price. The supply curve for bonds shifts to the right from S1 to S2. It will form a new equilibrium. In these new equilibriums, which is E2, we can see that the bond price will fall from P1 to P2. This is show the effects of expected inflations on the quantity of bond demand and supply in the market. As I mentioned earlier, interest rate and investments are both negatively affected by inflations. Well, this is just the discussions of interest rate behavior based on the 4 selected subtopics. More detailed information may be available from the flipbook provided. See you in the next topic. Thank you. Hope to see you again in the next video with the next topic.